At midnight in Beijing, the silver tap didn't tighten, it snapped. While most of us were counting down fireworks on January 1st, 2026, Chinese export controls on refined silver went live, effective immediately. And within hours, Western buyers started getting the kind of email that doesn't feel like business. Canceled, denied, cannot ship. Not next quarter, not after the holiday, now. This is the event. This is the shock. China didn't just raise paperwork. China put a gate on the middle of the supply chain. And for a market that already runs on fumes, that gate is everything. Here's the part that trips people up. This isn't about where silver is mined. It's about where silver becomes usable. Ore is not a product. Concentrate is not a product. Refined metal is the product. And the world built its refining habits around China. So when China changes the rules, it's not China keeps its silver. It's China decides who gets the world's silver after it's processed. That's a different kind of control. That's the difference between owning the oil and owning the refinery. And on January 1st, that refinery door started closing. Now watch this. The paper price can sit there looking calm. Futures can pretend nothing happened. But the real market doesn't get to pretend. Factories don't run on charts. They run on deliveries. And deliveries just got interrupted. We're going to walk through what's happening, what it means, and why dealer prices jump like someone lit a match under them. No fluff. No maybe someday. Just the chain of events and the chain of consequences. And yes, this is educational. We manage risk. Note this down. There are a few fake channels using my face right now. This right here is my only official channel, and this is where you'll get every real update first. And yes, very soon I'm launching a specialized YouTube membership for our loyal community, where you'll get information and breakdowns you won't see anywhere else. Also, quick one. How's the new look and studio setup? And if you've got any suggestions for future videos, drop them in the comments. And make sure you reply to the pinned comment too. I'm reading that thread closely. First, the mechanism. China rolled out export licensing requirements for refined silver that were announced earlier, then enforced on the new year. The structure is simple but brutal. To export, refiners need to qualify. And qualify is engineered to eliminate most of them. Minimum annual output thresholds, minimum credit line thresholds, and even after that, shipment by shipment approvals. That last part matters more than people realize, because a license is not permission. A license is an application to ask permission, every single time. Think of it like this. You can have a driver's license, but every time you start your car, a bureaucrat has to approve your ignition. That's not driving, that's waiting. So what happened when buyers asked for January and February metal? A wave of no. Not vague, we'll see, not delayed, hard no. And the no came with numbers, specific numbers, the kind of numbers you only quote when the rule is real and you've already been told where the line is. That's the tell. If a supplier says, we're not sure, the system is flexible. If a supplier says, we produce 62, the minimum is 80, the system is already enforced. So the question becomes, how many refiners are actually eligible? And more importantly, even if they are eligible, will Beijing approve their shipments to Western buyers? Because what a government wants is not trade. What a government wants is leverage. And leverage is built on selective permission. Here's the part we need to face without sugarcoating it. If your factory in the US or Europe relies on refined silver coming out of China, your supply chain just became political. Not expensive, political. And political supply chains don't resolve with a better shipping quote. They resolve when the gatekeeper decides your industry is worth feeding. Now let's zoom into the real-time evidence. Buyers called and messaged refiners across different regions and different sizes. The responses fell into 3 buckets, and every bucket points to the same reality. Bucket 1. We do not meet the thresholds. This isn't a temporary delay. This is, we are not legally allowed to export. And it doesn't matter if that refiner has shipped to the West for 10 years. Relationships don't overrule policy. Bucket 2. We have a license, but each shipment needs approval. That sounds like progress until you hear the timeline. Weeks, not days, weeks. And then the real punch. Approval is not guaranteed. Approvals can be denied for any reason. That phrase is a weapon. It means the decision isn't commercial. It's discretionary. Bucket 3. We are waiting for clarification. Translation, we're not taking the risk and we're not making promises. Put those 3 buckets together and the result isn't 93% denied or 80% denied or 50% denied. The result is functional paralysis. And paralysis is worse than shortage because it kills planning. You can't plan around maybe, and factories hate maybe. Now watch the next domino. Contracts. This is where the story stops being a policy memo and starts being a production problem. When a refiner cancels a standing agreement, that's not a headline. That's a line shutting down in the future. And we need to understand the time lag because this is how markets ambush people. A manufacturer can have 3 months of inventory and look fine for 3 months. Then one morning, someone walks onto the floor and says, "We're out." And the next sentence is the one that matters. Where do we get more? If the answer is you can't, the whole system moves from efficiency mode into panic mode. That's the moment premiums explode. Because premiums aren't just extra. Premiums are the market screaming, replacement is not certain. Now here's the key misunderstanding that breaks retail brains. People think the silver market is set by mine supply and jewelry demand and investor sentiment. That's part of it. But in a shock, the market is set by the buyer who must have metal, regardless of price. That's the industrial buyer. A solar line can't tell its customers, "Sorry, we're waiting for spot to come down." A medical device maker can't tell regulators, "We'll deliver after the chart cools off." They don't get to time the market. They have to secure material. So when China puts friction on refined exports, those buyers turn outward, fast, and the whole world becomes a single, crowded exit door. Now we're at the math, and this is where we separate fact from interpretation. Fact: China is a dominant player in global refining capacity for silver. Fact: refined exports face new licensing and approval barriers. Fact: barriers reduce reliable flow of refined metal to foreign buyers. Interpretation: the reduction forces the West to compete over a smaller pool of non-Chinese refined silver. Interpretation: competition expresses itself first in physical premiums, then in paper price repricing. So let's talk about the pool. If hundreds of millions of ounces of annual refined export flow becomes restricted, the replacement doesn't appear by wishing. Refining capacity is not a faucet you twist. It's a factory you build. And building it takes time, capital, permits, and expertise. That means the short-term replacement is inventory and redirection. Inventory: what's sitting in accessible vaults, not already promised. Redirection: what can be diverted from existing customers without breaking other contracts. Here's the ugly part. Most supply is already spoken for. Silver isn't like a luxury good where half the demand is optional. A lot of it is embedded into industrial processes that don't pause politely. So when a big chunk of refined supply becomes uncertain, the price has one job: rationing. Price doesn't go up because investors are excited. Price goes up because the system needs to force someone to stop buying. That's what higher prices do. They kick out the weakest demand. And that's why this moment feels so extreme. Because the weakest demand might be jewelry, might be silverware, might be discretionary electronics. But the strongest demand, energy transition, medical, defense, automotive, doesn't blink. And when strong demand doesn't blink, the price has to move harder to do the rationing job. Now this is where the paper market gets exposed. Paper is a casino. Physical is a factory. Casinos can trade the idea of silver all day long. They can shuffle contracts, roll positions, and call it liquidity. Factories can't consume liquidity. They consume atoms. So if paper says $77 and physical says $120, that's not a normal premium. That's a divergence between two worlds. It's like seeing a restaurant menu list steak at $10 while the butcher is selling raw beef at $30. You don't argue with the menu. You ask, who's lying? And we don't need conspiracy theories here. We need incentives. Dealers reprice when replacement cost changes. Wholesalers reprice when supply risk rises. Industrial buyers reprice when the material becomes uncertain. So when you see dealer prices jump 30, 40, 50% above paper, that's not greed, that's protection. If a dealer sells you metal at a price they can't replace, they are donating inventory. And dealers don't donate, they survive. Now the open loop. What happens when the paper market reopens and realizes the physical market has been living in a different timeline for 24 hours? That is where gaps are born. Because paper doesn't like to be embarrassed. Paper likes to pretend it's the price. But when real buyers start pulling on the deliverable supply, paper has to adjust. And this is why the first trading sessions after a holiday can be violent. Thin liquidity, fresh shock, everyone hitting the door at once. Now think like a desk trader for a second. You come back in on January 2nd. You see policy enforcement. You see refiners denying shipments. You hear from clients who need metal. You check physical quotes and they're screaming higher. Do you sit calmly and wait for a perfect entry? Or do you buy before your competitor buys? That's how repricing happens. Not by debate, by urgency. Now, let's go one layer deeper, because this is where people miss the real lever. China didn't just restrict exports. China built a filtering system. By setting high thresholds, they shrink the number of eligible exporters. By requiring shipment approvals, they gain veto power over each flow. By keeping reasons discretionary, they gain leverage over destination and buyer type. That means the question isn't, will China export silver? The question is, to whom, for what purpose, and under what political conditions? And that's the point. If you want bargaining power in a world that's turning strategic, you don't need to ban everything. You need to control the valves. Now, if we're smart, we ask the uncomfortable questions. Which industries get priority? Which countries get priority? And if we're wrong, where will it show first? Because the first signal isn't always the spot price. The first signal is denial letters and delivery times. So here's what we need to watch. Delivery lead times from non-Chinese refiners. Premiums on high-purity industrial bars. Availability of specific forms, grain, shot, specialty powders. And the language and supplier emails. Force majeure, allocation, domestic priority, regulatory restrictions. Those phrases are the smoke before the fire. Now, let's talk about why this can't be solved by a quick pivot. People will say, fine, we'll just refine elsewhere. Okay, with what? Refining capacity is concentrated for a reason. It's expensive. It's regulated. It's optimized over decades. You don't spin up a new high-purity line like you spin up a new website. And even if you could build it, you need feedstock agreements. You need logistics. You need compliance. You need customers willing to pay higher costs. So yes, the West can rebuild refining, but that's a multi-year project, meaning the next few quarters matter most, and markets price the next few quarters aggressively. Now, what does all this mean for us as viewers, as participants, as people trying to understand the game? It means we stop treating silver like a metal and start treating it like a supply chain. Supply chains break at choke points. China is a choke point. And when a choke point tightens, the entire downstream system competes for scraps. That competition shows up as one thing first: premiums. So if you're watching spot and feeling calm, but your dealer is quoting 50% above spot, that's the market giving you a warning label. Now let's address the skeptic voice in the room. But isn't this just temporary? Won't they loosen it? Possible, but we don't trade on hope. We trade on evidence. And the evidence right now is enforcement behavior. Denials, cancellations, long approval timelines, low reliability. That's not a grace period, that's a gate. Now here's the contradiction that gets people. If the paper price is low, the headlines will say, no problem. If the physical price is high, the dealers will say, scarcity. So who's right? The answer is the market that must deliver. Because you can't settle an EV supply chain in cash. You can't solder a circuit with a futures contract. You can't plate a connector with a Bloomberg quote. You need metal. And in any commodity, the moment physical tightness shows up, the paper price is living on borrowed time. Now the second open loop. If industrial buyers can't source refined silver reliably, what do next? They don't just pay more, they change behavior. They stockpile, they lock contracts, they prepay, they buy upstream, they acquire stakes. And when buyers stockpile, availability disappears faster than the shortage itself. Because the shortage becomes psychological. That's when the shelves empty. And that's when the premium becomes the price. So the move we're seeing, dealers jumping to triple-digit quotes, is not the end. It's the beginning of the behavioral shift. Because once buyers accept that flow is uncertain, they stop operating on just-in-time. They operate on just-in-case. Just-in-time is efficient. Just-in-case is expensive. And expensive means higher price floors. Now let's make this tangible. Imagine you run a manufacturing line that needs silver paste. You have 90 days of stock. You get a denial letter. What's your next move? You call your alternative supplier. They tell you, lead time is 18 weeks. Now your brain does the math. 90 days is 13 weeks. You are 5 weeks short. That means you don't negotiate price. You negotiate survival. And that's why physical prices jump first. Because physical is the emergency market. Paper is where people argue. Physical is where people pay. Now let's talk about what we do with information like this without turning into gamblers. We separate scenarios. Base case. Exports continue but slower and more selective, raising costs and premiums. Upside case. Approvals remain tight, causing multi-quarter shortages and forcing a violent repricing. Downside case. Policy is softened or bypassed, reducing the shock and compressing premiums. We don't marry one story, we watch the data. But we also respect asymmetry. If you ignore the risk and it's real, you get blindsided. If you respect the risk and it fades, you might pay extra premium and lose some opportunity cost. That's the trade. And we decide based on our goals. Trading versus hedging versus long-term positioning. Now here's the piece nobody wants to say out loud. If this is real, the supply chain is already moving behind the scenes. Not on YouTube, not on Twitter, on procurement calls. And procurement calls don't announce themselves. They just quietly pull supply off the market. That's how the public wakes up one day and sees out of stock. So if you're watching this and thinking, why is it happening so fast? It's because the buying started before the headlines. Now, 2 questions for us, because I want to know how you're reading this. If physical is already pricing silver like a scarce material, do you think paper catches up quickly, or do you think paper fights it with volatility? And second, if you were an industrial buyer, would you wait for clarity, or would you lock anything you can find, even at a painful price? Drop your answer in the comments. I read them, and our community learns from each other. Now, the final tension point. What happens next isn't just up or down. It's who panics first. If institutions panic buy futures, spot gaps higher. If dealers get drained, premiums explode even more. If refiners outside China get flooded with orders, lead times extend and contracts get stricter. And if governments see strategic industries at risk, they step in. That's the wild card. Because once a metal becomes strategic, the rules change. Allocations, priority lists, restrictions, subsidies, and sometimes confiscatory policies. I'm not saying that's guaranteed. I'm saying it's a risk that appears when supply chains become national security. And silver is already embedded in solar, electronics, medical, and defense. So we watch the language from policymakers, not just the charts. Now, we end where we started. Facts first. On January 1st, 2026, Chinese refined silver export restrictions took effect. Refiners began denying export orders or warning of long approval timelines. Western buyers began receiving cancellations and scrambling for alternatives. Physical dealers began repricing rapidly to protect replacement cost and inventory. That's what happened. What it means is the next chapter depends on follow-through, whether the gate stays tight, and whether the non-Chinese supply chain can absorb the shock. Either way, the market just got a wake-up call. And if you want us to keep tracking this with zero fluff, hit subscribe. Short, simple, and it helps the algorithm put these updates in front of the people who actually need them. Because this story doesn't end with a policy memo. It ends with either a quiet reroute or a very loud repricing. And the first people to see it won't be traders. It'll be the factories that suddenly can't get their metal. Watch lead times, not the headlines daily.